Good afternoon, judges. My name is Drew DePasquale, and I'm a part-time MBA student here at the university, and this is NeighborFund. NeighborFund is a crowdfunding real estate investment platform that provides a way for community members to pull small amounts of money together to fund a targeted residential renovation project hosted by a local and reputable contractor. So right now, the team is myself and Shane Simonelli. We're currently looking for an underwriter, so if you guys know a good underwriter, please send them my way. So why is the time right for a crowdfunding real estate investment idea? So if you look at these charts here, the blue lines, the blue figures are 1975, and they've all been adjusted for inflation. What I'm trying to point out here, though, is that the median house cost in Massachusetts has not changed since 1975. What has changed, though, is the rent. It's nearly doubled since 1975, and what that means for 25 to 34-year-olds choosing to rent is that they're spending almost over 50% of their income on rent alone. So if you throw that into a millennial math problem, this is their monthly wage after taxes, take out student loans, that rent figure I just showed you, that leaves them with $113 a month. And in order to save up for the median house in Massachusetts, put down the minimum down payment of 5%, it's going to take them over 12 years to do so. That's unreasonably hard. So we look at some social trends here. Millennials really care about their community. They're all interconnected through social media. We're highly educated, but we're also highly in debt. We are the largest generation in the United States right now, and 23-year-olds are actually the largest age group of that generation. Only 13% of millennials own homes today. That's down from 18% in the 1980s. And just if you think back to the 1980s, we were dealing with double-digit mortgage rates compared to sub 4% today. And lastly here, over 30% of millennials still live at home with mom and dad. So judges, I think it's time to get out of the basement. So if you think about how real estate has changed, anytime you're going to go buy your house, rent, look for a vacation property, or even get a renovation idea, it's all going to be done online. Same can be said for the most part with personal investing. These platforms have made it insanely easy to go online and invest your hard-earned money into the markets. The last bullet here is the DIY revolution. So I blame this primarily on television programming and big box retailers, but they've basically changed our perception of what a renovation is and how we get there, and they've created this insatiable desire to crave the big reveal. So if you read this quick quote about HGTV, it's so watchable because it features attainably realistic ritual reenactments of the American dream every half an hour. So tying this all together, Shane and I are really good friends. We have construction and project management background. We wanted to start renovating homes together, but we quickly found out we don't have this one thing, money. So with the 2012 Jobs Act, crowdfunding basically made access to capital for individuals a lot easier. So NeighborFund was born in order to make real estate investing accessible for everyone. So let's take a look about how the model actually works. So before we get into any kind of renovations or construction, we want to make long-term relationships with a network of trusted contractors in a targeted area. This is going to help us keep our underwriting processes a lot more efficient because we're going to know who we're dealing with, and it helps us provide a quality product to our investors. We're also going to take first lien on the property to make sure we secure the funds. So if you think about NeighborFund as a home, trust and underwriting principles are really the foundation of our business. So the next phase here is that we qualify a project, we post it on our website, we offer a percentage of that up to the crowd to invest in at a fixed yield. This will be done through a debt instrument. And so here's a sample project that will go on our website. We'll have all the photos, risk assessment, description, basically everything you need to make an informed decision on the investment. And when you do decide to invest with us, it doesn't stop there. So we want to make an active investment experience. So we're going to give project updates all along the way so that the investor crowd can understand what's going on and even provide them with how-tos to do certain elements of the renovation themselves. So it's like your own little HGTV show. Furthermore, we're going to provide financial and homeowner tips and blogs in order to increase financial and real estate literacy with our crowd. And then, as you saw earlier, I tried to demonstrate millennials are a little bit cash-strapped. So we want to provide a way for them, basically pave a pathway to homeownership for them and give them an integrated and goal-oriented dashboard where they can set a financial goal and achieve that goal through our investment platform. So after the renovations are completed, we're going to have an exclusive open house for the investor crowd only. And basically what we're going to do is both in person and virtually. And this is the crowd's big reveal moment. After the open house, we will facilitate an online auction. What this does is it continues that pathway to home ownership for the investment crowd, gives them first right to bid on the home. And then secondly, it solves a very important problem for our contractors, which is inventory turnover. So once the home is sold, all the earnings will be distributed. The investor crowd will get their interest return. The contractor will profit from the sale of the home, and NeighborFund will get the principal that was loaned out back. So how this all works as far as a revenue model, the contractor will come to NeighborFund for a loan. We will underwrite that loan and charge an origination fee known as points and an APR on the life of the loan. So then after that, we will post that on our website, and NeighborFund will then offer a percentage of the loan value to the crowd to invest in at a fixed yield. And this is going to be slightly lower than what we're charging the contractor on their APR. So in summary, NeighborFund will earn a revenue on the fee and the APR over the life of the loan, less the interest owed back to the crowd. So we took this idea of crowdfunding real estate investment and we asked 118 people. 51% said yes, they would be actually interested in investing. We took that data and we got 73 responses from our target market of 25 to 34-year-olds, and 58% said yes. And judges, just 3 weeks ago, these competitors of ours just raised $34 million in Series A funding. So the market is hot and the time is now. And I'm sure you're wondering, can we even do this? Is it legal? Well, yes, in the green states. So Maine and Massachusetts are really our focus entry points for this model, and that's because they've enacted their own interstate crowdfunding laws that allows us to have non-accredited investors invest a certain percentage of their income towards crowdfunding. New Hampshire has a bill on the table. It's in the process of being passed, so once that happens, we will be in New Hampshire. So if you take a look at our competitive analysis here, really how we're going to differentiate is by making this accessible to everyone and making it easy to do so. We're going to provide a suite of educational tools, and we're going to set our minimum investment at $5. But our number one differentiator, and no one in the market is doing this, is adding a social component to the investment. And we're going to do that through donation channeling. So judges, as you know, anytime you invest in the markets, you're going to be responsible for some kind of interest liability at the end of the year or capital gains. We will show you how to calculate that at the end of your return. We'll show you how to use a percentage of your return to offset that liability with a charitable donation towards a targeted community improvement project. This does something else that no investment does, and that's to provide immediate social impact. So how are we going to get to the millennials? Quite simply, we're going to go to where they are, and that's social media. That's where they get all their news and updates from. That's where we're going to advertise. As far as reaching contractors, we're going to do that the old-fashioned way, boots on the ground, word of mouth, trade shows, conferences. And we're actually going to use Angie's List, which has been a proven way to narrow down the search to find local reputable contractors in a targeted area. So financial projections, for year one, with 12 projects complete, we are projecting to make $49,000 in net income. By year 5, through continually expanding to different states, expanding the communities in which we're trying to improve, we expect our net income to be $3.2 million by end of year 5. So financing needed, in order to launch, we're looking at $800,000. $200,000 would be for day-to-day operating expenses, and then $600,000 to finance the contractor loans, which I was talking about earlier in our revenue model. And I want to note here that that's completely independent from the day-to-day operating expenses, so it's a different source of capital. And then if we are to win the Holloway Prize money, we'll use the money to begin our proof of concept. So judges, in summary, NeighborFund seeks to make real estate investment an attainable and logical way for millennials to gain financial independence, connect to and improve their communities in which they live in, and get their own piece of the American dream. Thank you very much for listening, judges. I'll be happy to answer any questions you might have.
I have a question.
Sure.
I was just thinking about the whole proposal and the crowdfunding and not being very up to date on the economics of that. So as an investor, if I came in and invested, what is the return to me? Is it a fixed guaranteed interest payment?
That's a great question, thank you. So basically there's two forms of crowdfunding. Equity crowdfunding is getting all the press, but debt crowdfunding is a different thing. That's what we're doing. And so with equity, your timetable of return can be much longer because it's based on different elements of the capital stack. We're doing short-term residential with debt instruments, so we have a fixed time frame of when we're saying, so if you come invest in a project, you'll get your APR at 12 months. And
so at 10% or whatever.
Right.
How about, is there an opportunity to share in the upside at all once you get the return or margin that you would want? Have you thought about something like that?
Yeah, so that gets into the equity piece of it. So we'd have to be able to change our model a little bit. It's definitely something we are thinking about because, like you just said, there is tremendous upside potentially, and so we haven't quite worked that out. We wanted to focus on debt really because it's a lot simpler, I think, to basically propose something to a non-accredited investor.
One more question about the whole finance aspect of it. What happens if you can't pay them their guaranteed return or their basis? What happens if you're upside down? How does that work?
That's a great question. So definitely that's a risk of it. I want to point out that this is not a guaranteed investment. I mean, it's like anything. You can invest in the stock market and lose all your money that way. There is risk to it. But so how we will try to mitigate that risk is by taking first lien on the property. So if, say, the contractor flakes out or disappears one day, we'll be able to bring somebody else in, finish the job. We'll have to hold it until we can actually sell the house. But if there's a dire case where we need to get that investor money back, I have built into my cash flow projections that we have an operating expense, and hopefully that operating expense will cover that slight risk there. I just want to point out hard money lending default rates are under 1% nationwide, and regular mortgages nationwide is 3.21% default rate. So the risk is small, it's there for sure, but that was a great question.
Yeah, I was just thinking a lot about the guaranteed return component.
Yeah, we're not guaranteeing anything, right?
Okay.
So you're taking ownership in the property?
We're taking first lien position on the property.
So title?
Yeah.
Okay, so how do you qualify in a project, and how do you determine, how do you qualify a project? Do you have people that go out
I have a
find
slide
this?
here, underwriting principles. So these are kind of all the things that we will go through. The green ones are the ones that we're really focused on. I'm not an underwriter by trade, but that's why I mentioned in the beginning we want definitely underwriters to join our team. And this is how we will qualify using these somewhat basic but very proven principles to underwriting and qualifying a project.
How would you find these 12 projects?
So the contractor brings the...
Okay, so you're sourcing them
us
through the opportunities of the contractor, so they're going to you as an alternative. I got you.
Yeah, we are an alternative source of capital for them, right. And another point of technology that we are thinking about including is some kind of geolocation technology where on an app-based model, a potential investor could be in a neighborhood where they take a photo and drop a pin of a proposed house and send it to NeighborFund, which we can then use that to qualify ourselves and tell one of our contractors to go check it out.
So the lien is against opportunities that you don't take title to, that the contractors just have big jobs that they may be taking on and need financed, and
yeah, so
the contractors aren't going to find places for sale and deliver them to you, right?
Right. Yeah. So we did a lot of research around what that contractor looks like, and it's the smaller tiered contractor that's trying to grow their business, and a lot of these contractors do only a handful a year, but we surveyed 6 in the Boston metro area, and we had deep conversations with them about that. And really what happens is they have their private equity people that they know, but a lot of times they see a project and they want to act on it, and they can't quick enough because the private equity guy's tied up with their capital in another project or something like that. So we provide a viable alternative to.
Is there a component here for you guys to find opportunities yourselves that you don't
yeah,
depend
that's
on
something that
contractors?
yeah, that's something that eventually we would like to get into as far as, because we thinking long-term growth, we want to start franchising contractors. So it's a NeighborFund contractor, and then we are sourcing all these opportunities ourselves, buying the houses, renovating them, and then putting them on our platform for investment.
First off, Andrew, good job getting this far.
Thank
Nice
you.
job with the presentation. I'm not familiar with the new rules on crowdfunding versus the accredited investors, which I'm very familiar with. So do you need a copy of my W-2 and you take a percentage of that and that's the most I can do?
Yeah, so they haven't finalized how that process looks like for unaccredited investors, but really, so Massachusetts and Maine really have similar requirements for non-accredited, and it's based upon, like you just said, so if your net income is under $100,000 a year, then you're only allowed to invest up to 5%. So if you make basically $90,000 a year, you can invest $4,500, and we have to validate that through using a W-2. And so, I mean, if you think about like E-Trade, Scottrade, you have to give them a lot of things up front in order for them to qualify you. So it'd be a similar process in that.
Okay, so I just passed you my $4,500. Do I put that into a pool and it sits and waits for everybody else to fill it up? Or is it just sit here in my bank account until you say, yes, we're a go, and then you have to go back to all those people and pull the money in?
No, so how you do it is you find the project you'd like, and then basically you've been qualified by us, and then you're able to wire money in from your account. And then you find the project you want to invest in, and then there's a goal. So if we say we need $50,000 and there's like a 30-day goal time frame, if the $50,000 is released, your money was, you basically pledged your money and it sits in like an escrow, and then it goes once the project has reached its goal. If it does not reach its goal, you don't lose a dime.
Okay, so did I buy stock with my $4,500? Did I?
No, thank
my
you. Yeah,
partner?
you bought a derivative debt instrument called a borrower dependent note. It's like a promissory note. So this is basically a debt derivative instrument that is it's basically akin to the first lien position, and it's basically a piece of paper that says this asset is backed by this lien position.
So it's only to that one particular asset this project
Yes.
has
It's
independent
not a
other
REIT,
projects?
no.
Okay, just checking.
And that's why we wanted to make it targeted, because with the neighborhood aspect of it, we would intend to do a few houses, because the more houses that are turning over in a positive way, that increases home value, general aesthetics, and more people are involved, so more people see what's going on, and we get more investors.
If I'm a neighbor putting money in,
Sure.
am I subordinated to your first lien? So if I put $4,500 in, what happens if you never complete the project and you end up going underwater?
Yeah, so like I said earlier, there is risk in that, but you would be, essentially the crowd is our first priority, getting that money back. So if there's any kind of like liquidation
Right.
of like just moving the property, selling it to some other person who wants to hold it and do whatever, you would be the first one to get your money back. And as I mentioned before, we do have operating expenses built into the cash flow.
Sure. So
would
your
kind of
spread
help
is actually
circumvent
going to help.
that. Yeah.
So if I'm a neighbor and I'm contemplating what to do with $1,000, what are my choices? So
As far
you
as-
talked about, you could go into the stock market, you could do some other kind of more secure debt instrument. And so what's the motivation, do you think, for a neighbor to free up some capital here?
Yeah, so what we wanted to do was, and I talked about it earlier, was that, so if you look at these figures here, we have about 3 million people in the Boston metro. This is not Boston proper, this is Boston metro, the whole outskirts here. And so the larger percentage of that is the growing millennial movement into the Boston area. And so why we're focusing so much on that is that millennials care about their community, and when we can offer something that has a social impact and a financial reward, I think that's going to help you make your decision as far as like, do I want to invest in a stock I don't really know much about, or do I want to help my community grow and improve?
But what if you're not really committed to the community? You're 24 years old and you've got a $1,000 a month apartment, and you've got a 1-year lease.
Yeah.
I mean, is this the kind of thing that actually, I'm sort of trying to get to a subset target audience that is most likely to want to cough up the money because either they have it or they're committed to that location.
Sure.
Or they see it as a good return compared to alternatives. And so that's the other thing is when you think of a low interest rate environment and a 10% guarantee, that sounds pretty good. But if interest rates go up to 5 or 6%, I assume you're going to have to maintain your spread, and you're probably going to have to go up on what you're offering to the neighbor.
Yeah, definitely. I mean, there though, it's all going to be in flux with what we have, what the market, what the hard money lender rates are compared to what the contractor, what we offer
Right.
the contractor. So we're going to stay in line with that. So our spread's going to just kind of like, if the market's moving in that direction, that's where we have to kind of follow.
Right.
But those are,
So you'll know when you're out of bounds on the market because you won't get the funding.
well,
You'll
the
see it.
contractors will probably be coming more to us because we can offer,
Right.
these investment types, through the crowd. And we
So-
want to actually open up a larger percentage eventually to the crowd in order to basically sustain it through the crowd.
So let's go to the contractor. And what problem are you trying to solve for them?
So we found out that they have private money or private equity individuals that they have deals with, or they just call, say, I have this property I want to invest in. They also use hard money lenders. And what they're finding is that a lot of times they're not able to move quick enough for them. So if we're able to offer something that kind of is another alternative to the two I just mentioned, that provides a service. And then also, we're basically giving them marketing. So unlike the hard money lenders and unlike the private equity guys, we have a platform where local investors are looking at the construction. And like I said before, in this slide, we're giving project updates. And so they're basically on display. So that's a form of marketing, and that will also increase their business. And then if you think about, if the majority of the crowd is localized, next time they have a toilet leak or something like that, or need to replace the roof, who they're going to call? They're going to call the guy that just made them 10%
So
on their investment.
are you anticipating that you'll work hard finding contractors that work in your model and that are happy with the economics of it? And then what happens if they find better opportunities to make more money? Because I assume that generally contractors in demand would be able to make more money than what you're offering. It's just you're offering something that is access to capital that some of them may not have. Then what happens if they get good enough? Do you expect you're going to have churn in the contractors?
Yeah, so, I mean, again, it comes back to like who we're targeting, and we want contractors that are ambitious in growing their model, growing their own businesses, and this is a way for them to do more renovations and increase their bottom lines. But you're right, I mean, there could be this threshold of like, okay, I've done enough of these crowdfunding deals and through NeighborFund, and now I'm profitable enough where I can just go do whatever I want and fund all my stuff fund all my future projects by myself. That, I mean, there's a risk in that, but there's also going to be the other guy that's getting to the threshold where we bring in and go find him. There's a lot of resources out there for capital, but when the markets get tighter, as we see it's cyclical, we're going to be a viable opportunity for the contractors to go seek capital.
One more question.
What's going to prevent the contractor, because he's delivering the opportunity, from overcharging? Or what if he's under budget? I mean,
Yeah, so that's a great.
If
So
you're
it's
not
really-
pitting them against one another in a sense, or mitigating your risk in a sense, if I'm going to invest a small amount of cash, I'd rather do all 12 projects a little bit, because 10 of them are going to go. So I like that concept as a small investor,
Yeah.
that I'll
So-
probably come out at 8% or 6 or something. But
Yeah, so is the question more around like from the
the contractors, yeah, I mean, you only want honest contractors.
Yes.
Good luck, and they're out there.
Yes, they are.
And you'll get them, but you're going to have to sort them.
Yeah, so like I said, I
And
have
if they're
a
bringing the
strong-
opportunity, they may be inclined, and if you could pull the buying, you have 12 projects, and you could buy and save money and do things like
Yeah,
that,
so
then you've tied that contractor
They have
in
to
a little
submit.
bit.
They'll have to submit all kind of estimates for the work to be done, and that's why I said before. Shane and I have a strong construction.
So
and
you
project
can
management
sort that
background.
out. That's-
And I have many years of
That
estimation
answers it
software,
right there.
so I can look at an estimate and tell you if it's
Well, that answers
if
it.
it's if it's true or not.
That's an important feature,
Yeah,
a
definitely.
very important feature.
Yeah.
It's a-
Okay.
Oh, I was just
Yeah.
gonna say,
Quick question. 45 seconds.
Please.
okay, I was just, and I don't know if it's much of a question or anything, but the whole concept of people putting in $5, if you raise that bar a little bit more, you're gonna have much less of an administrative burden. Have you given thought to, maybe bringing it around $1,000 per opportunity?
So, yeah.
So that you're not dealing with 20 interest payments as opposed to, for,
Definitely. So and
Five
that's
dollars
a model we have to figure out through technology.
Yeah.
And we really need, we want to make it accessible because as I displayed, the millennials are a little bit cash strapped, right? So
Yeah, you're right.
we want them to be able to get in. And all of the other competitors are really focused on accredited, and they have their minimums at either 500 or 1,000.
okay.
But there's a sample called Ground Floor, and they work out of Georgia, and they do the same small investment.
Got it. Thank you.
And the average investment is $1,200 on average.